Hello guys, it's Dale here. In this video I'll talk about how to trade when the markets are very volatile and when there are sudden spikes. So I'll show you how to trade in a very risky environment, and I'll talk about some basic stuff, what anybody can do when markets behave this way, and also I'll show you some advanced trading techniques, mainly using the order flow software. And also I'll point you to some software that can help you trade when markets are volatile, when there are spikes. So we'll get to that as well. So let's get started with a little introduction and with reasons why the markets are actually volatile and when there are those spikes. So first reason is when markets are uncertain. So when markets are uncertain, they tend to be more volatile, and also spikes occur more often. Currently, the uncertainty is because of the war, and also because of the collapsing banks and the risk that it brings. So that's the uncertainty that brings volatility to the markets. It's also macro news. Currently, hot topics is interest rates and inflation. Those are the big topics now. And when there's macro news, which directly or even indirectly affects the decision about interest rates or about inflation, then markets get very volatile and spike moves occur because markets are very tense about such news. Another reason for increased volatility and price spikes is institutions manipulating the markets. This happens every day. It doesn't need to be news related, it's just the big guys playing their game, chasing after liquidity. So this is another reason why the markets are volatile. Alright, what also falls in this category is liquidity runs. This is basically when the trading institutions are chasing after liquidity, and for example, if there's a lot of stop loss orders in the market accumulated in sort of stop loss clusters, I call those stop loss clusters, then the price likes to shoot past those stop loss clusters very fast, because stop loss are market orders, and if those get activated one after another, boom, 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 then the price tends to move very quickly past such zones. So those are liquidity runs, and also some markets are just volatile by nature. To give you a couple of examples, it is DAX, crude oil, cryptos, and some pairs, which include the British pound and the Japanese yen. For example, British pound, Japanese yen, US dollar, Japanese yen, euro, Japanese yen, those have always been a bit more volatile pairs with more spikes than the other more calmer forex pairs. So that's for the reasons for the increased volatility and spikes. Now, to give you some definition of what a spike is, what this is going to be all about. A spike is a big price move where price is moving fast and aggressively in one direction. For example, like here, right? This is a huge spike. Now, when we are talking about day trading, what I consider a big spike is when the price makes 20% of average daily volatility in 5 minutes. This is just a rough number, you know. I know guys like exact definitions, so here is one, but don't take it as a rule that's carved in stone, alright? Just roughly. Let me show you on chart how you can find what that 20% of average daily volatility is. So let me switch over to TradingView platform, and let me show you on US dollar, Japanese yen. So before you, this is a simple price chart of the US dollar, Japanese yen, and below that, what I loaded up is an ATR indicator, average true range, and I set it to 200. And what I'm gonna do is change the time frame from 5-minute time frame to a daily time frame. So this is the daily time frame, and here This is the average true range indicator. Currently, it's showing that the average daily volatility is 140 pips. Alright, so on average, US dollar Japanese yen makes 140 pips per day. So, what I would consider a spike move in my day trading would be 20% of 140, which is 28 pips. So, spike is when the price on the US dollar Japanese yen makes 28 pip movement, one directional movement in 5 or less minutes. Alright, when you see that on chart, then it is a spike move. Now, as I was saying, this doesn't need to be that exact, okay? It could be quick movement, 25 pips, and you will just know that the markets are spiking and that this is a spike, alright? But this is just a rough number to give you some idea of what I'm going to be talking about when talking about spikes, alright? So let me go back. Now here is what you want to do when you are trading and there is a sudden spike and you are thinking whether you should stop trading or continue trading or what the heck is going on. So the first thing you want to do is you need to know whether the spike is news related or no. Because if it is news related, then it is a very risky situation. So there are two options where you can discover that, whether it's news related or no. It's forexfactory.com. Everybody knows this site, right? And the second one is Live Squawk. Now, the Forex Factory is a bit slower, so maybe there is a spike move and it actually is news related, but the news, especially if it's unexpected news, may not show at Forex Factory just yet. It may take some time. So that makes the Live Squawk a better option, because if there is unexpected news, you'll instantly know. Because the Live Squawk is an audio service, alright? This was free in the past. Unfortunately, you need to pay for it now, but there is a trial, so at least you can give it a try. Let me show you the site real quick. This is the Forex Factory site. Everybody knows this one. Latest news is in here. If the news is important, then there is a red icon here. Alright. Right now there's no red news because it's Sunday. So yeah, that's Forex Factory. And this is the Live Squawk. Alright. Here is the free trial, so you can give it a go. This way you won't miss any news. But as I was saying, you need to pay for this one. Alright, so after you've discovered whether the spike is news related or no, then you can make some trading decisions. If the spike was news related, then don't trade. Now I'm talking about intraday trades, alright? So let's imagine the price suddenly started to drop aggressively in a spike move, and imagine you have a support level here, day trading support. Then you go to Forex Factory or Live Squawk and discover that this sudden spike is in fact news driven. For example, some unexpected news about the war or about banks collapsing or some news about inflation. So if it is news driven, then you simply don't take the trade. Because the risk is that the price just shoots past your support. Because if there is news and the price starts to move in a spike move, then markets don't really care if you had a support there or no. Because if there is new fundamental information that moves the market, then strong support or resistance zones are not as strong anymore, alright? They don't play a strong role anymore because the fundamental news that affects the market is simply stronger. Now, if the spike move is not fundamentally driven, in other words, if it's not news driven, then you have three options. the safest option is skip the trade. So if you see a spike move going towards your support or resistance level, and if you are a conservative trader, if you don't like risking, then you simply don't take the trade. Now, I'm personally not like that. So what I do is the spike is not related to the news, I just trade it. That's the aggressive approach. So aggressive approach is to take the trade, but there is a third way. That's the best way in my opinion, and it's using order flow. Using order flow for a confirmation. That means that if there's a spike move moving towards your support or resistance zone, you open order flow chart, and in this zone you're looking for a confirmation. You are looking for a confirmation that the support is most likely going to work and that the big guys are reacting there, and most likely there is going to be a reaction. Now I understand that everybody doesn't have order flow or doesn't know how to use the order flow, so we'll leave the order flow just for now and talk about some stuff that everybody can use, and then later we'll have a look at some order flow setups, some confirmation setups, which you can use if you already have an order flow software, or if you decide to learn how to use it and use it for this kind of situations. So the thing which I want to talk about here is something that I call reversal trade. Reversal trade is when the price shoots past your support or resistance level with no reaction at all. Then after this happens, you can take a reversal trade. If you look at this picture, it will be way clearer. So in here, there was a heavy volume zone in here. Beginning of that heavy volume zone was right there. The price was moving in a spike move towards that support. And as you can see, it just shot past the level with no reaction. There should have been a reaction because there is a strong support based on heavy volumes. But maybe there was some significant news, or the big institutions just pushed through super aggressively with no reaction. It doesn't really matter. What matters is that there was a spike move, the price moved past support with no reaction. And what you can do is you can wait for the price to return back to that level. And when the price hits that level, you enter that reversal trade, which means short from here. You take a reversal position, right? Because from here, volume profile tells you to go long because that was a support, but the price shot past it with no reaction, which means that that support turned into a resistance, and you trade that resistance. So short from here. This is a reversal trade. And you can also use those when there's macro news. So if this was macro news related spike, the price is shooting downwards towards your support, but because this is macro news, you are not trading this. You just let the price shoot past the level, wait for the pullback, and take the short from there. All right, so that's the reversal trade. I'm trading those on a daily basis. They have a very good win rate, so that's why I recommend you give it a try. Now, in here I want to talk about software for trading spikes and also to protect your trades from macro news. The first software is called the Trade Manager. Here is a link which you can follow and download this tool for free. It's a MetaTrader 4 based tool, so you need MetaTrader 4, but I guess that shouldn't be a problem as that's the most popular trading platform. So check this site, download the Trade Manager, check it out. It has a lot of functions. One of them is that it closes pending orders before macro news. And what is cool about it is that it places them again after macro news has passed. You know what, let me actually show you that site. Now, if you are on my website, trader-dale.com, and it's not visible from the homepage, but if you go, for example, to videos, then it is in here, right? So you click it, and this is the page. This is the trade manager. It has a lot of cool functions. The one I was talking about is here, macro news protection. Here's a little video, or a little GIF I should say, which shows how this is working. So this is your order. Macro news, boom, order is out. Then there's macro news release. And after the macro news release, the order will be automatically put back to the market again, right? As you can see in here. So that's the trade manager. You can download it for free. In here, there is a download button and quick start guide. It is a pretty handy tool. So give it a try. Now, another tool which I have is TraderDale Expert Advisor. It's for MT4 and MT5. And what it does, among other things, because it has a ton of useful features that help to manage your trades, but among those, there are also features that help in macro news releases, in increased volatility scenarios, and one of the things that it does is that it automatically reads macro news from Forex Factory, and it blocks trading during macro news release. So the expert advisor won't trigger any trades when there's macro news release. What it also can do, and this is optional, you can turn this on or off, so don't worry about not being able to adjust anything there because it's fully adjustable. So another thing it does is closes your trades before macro news. And pretty cool thing here, it identifies spike moves and prevents opening trades against those spikes. So that's what the expert advisor does. Let me show you real quick. Here are all the settings that you can use with the expert advisor. This is the monster move filter. Currently it is set to 20 pips. It is also set to quit trades 5 minutes before macro news release. It also won't open any trades 30 minutes before macro news release. Below it, it says that it won't open any trades 30 minutes after the macro news release. Alright, so those are the functions that protects you against macro news and against spikes. Now this expert advisor is available for all members of my trading course. So if you are a member, you just go to download section and you can get it there. So those are the tools to protect your trades against spikes and macro news. Now in the next part, I'd like to talk about order flow, because I think order flow is an excellent tool for intraday trading and for trading when the markets are volatile, when there are spikes. So in here, I'll briefly show you a couple of setups which you can use when the markets are volatile and when there are spikes. Now, if you don't have order flow, you can get it from my website. As I was saying, it is trader-dale.com. If you click this button, which says Browse Courses, then it will take you to this page, and in here, there's the order flow pack, which includes the order flow software, video course, and volume profile software. So this is where you can get the order flow software. Now let me switch back. Now, as I was saying, I'll show you 4 little tricks which you can use when there are sudden spikes. Those confirmations are called absorption, limit order confirmation, confirmation on delta, and delta divergence. Now in this video, I'll do this just very briefly, but in the end, I'll give you some links and resources when you can study this more in detail if you are interested. All right. So the first confirmation is called the absorption, and it goes like this. Imagine that the market is spiking, going upwards really aggressively, and imagine that somewhere in this area there is a resistance which you want to trade, but you are not sure because there is a spike and you are not sure whether the markets are going to ignore the resistance or no. So you need to see some confirmation, some sign that the big guys who move and manipulate the markets, the institutions, are active there around your resistance. So absorption is, if you look at the footprint, that you see huge volumes both on bid and on ask. And what is important is that those are unusually huge volumes and they are both on bid and on ask, right? When you see this, the market is telling you that buying pressure is being absorbed. This is the buying pressure. This is the selling pressure. Those are the sellers. And if both those numbers are huge, unusually huge, then it's telling you that absorption is taking place and that it's likely that the price will turn and react to that resistance. All right, so this is a short trade scenario of the absorption setup. I like to use the 5-minute chart on order flow. In here it says 30-minute chart, but what I prefer is actually a 5-minute chart. So let me show you another example. This is example of a long trade scenario. Logic is the same. Price is dropping. This is not really a very strong spike, but we can imagine for the purposes of this video that there is a sudden spike moving aggressively towards your support zone. And around this support zone, you need to see some confirmation. If you see this, huge volumes on bid and on ask, then it is the absorption, right? In this case, number on ask is bigger than on bid, but it doesn't really matter too much. The most important thing here is that both those numbers are unusually huge. So this is market telling you that all the contracts that the sellers are selling, buyers are buying them, all of them in here. They are absorbing the selling pressure, and afterwards the price reacts to that. All right. So when you see the absorption around your support, then it is a sign that big guys are active here and that the price is likely to turn there. So when you see this, even if there is a spike towards your level, chances are the price will turn. So that's the absorption, first confirmation. The second confirmation is called confirmation through limit order. In here you see a long trade scenario. So imagine a very strong spike going towards your support, and what you want to see around that support, imagine this is a support zone, you need to see a huge number, huge volumes on bid, only on bid. This is telling you that this is a huge buy limit order placed by a big trading institution. And if you want to go long, it needs to be on bid, because on bid, buy limit orders show. So that's the confirmation. This is a short trade scenario where the huge number needs to be on ask. So again, imagine a strong spike moving towards your resistance. It could be somewhere in here. And you want to see unusually huge volumes pop up on ask, like here. This is the signal to go short, despite the fact that there was a huge spike moving against that position, against that resistance. But when you see this, that's a confirmation to go short. All right, so that's the limit order. Now, this is quite popular. Confirmation based on delta. So again, strong spike moving towards your support level. And that support level could be based, for example, on volume profile or on some price action setup or some setup that you like to trade. And in that support zone, you need to see that buyers are active. And you can watch this on delta. Delta are those numbers below each footprint. As you can see, as the price is dropping aggressively here, the deltas are negative. But in this zone, the price is rotating. So if you look at price action, not much is going on. But if you look at delta, delta is positive. That means buyers are jumping in. And there are more aggressive buyers than sellers. You won't see that on price action, but you can see that on order flow. So if you see this, this is a confirmation on delta that buyers are jumping in despite this strong spike, and it is telling you that the chances are the market will react to your support are pretty good. All right, here is the reaction. Now another example. This is a short trade scenario. Strong uptrend. Imagine this is a very strong spike, and imagine that this is a resistance zone from which you want to trade. The price is moving towards that resistance zone. Deltas are positive, which is quite normal when the price is rising. Deltas usually are positive when the price is moving upwards. But in here, in this footprint, delta turned negative. This is telling you that sellers started to jump in. So that's the delta confirmation to go short. Now, maybe you've noticed that there's also another confirmation that I've already talked about, and it is the absorption. It's taking place mostly in here, in these three heavy volume nodes. Huge volumes are traded on bid and on ask, all this in a resistance zone. So the buying pressure gets absorbed, and that's actually first confirmation. Second confirmation comes in 5 minutes later, when sellers are starting to take over and they are really aggressive. So this is actually second confirmation to go short from there. All right, so that's for the delta confirmation. Now there's one more confirmation that you can use against spike move, or actually it doesn't need to be spike move. You can use this also in, let's say, normal trading conditions, and it's called delta divergence. Delta divergence is when a price is moving one way, like this. This is 1 minute chart, and cumulative delta is moving the other way. What usually happens is price tends to follow delta. So if this happens, chances are that the price will drop. Now, there's a video which I shot, I think 2 weeks ago, about delta divergence, so I don't want to repeat myself. I'll just point you to the video. Again, this is my website, trader-dale.com, and if you go to the videos section in here, this is the video about delta. So check it out. I'm sure that you'll like it. Now, if you guys are interested in learning more about order flow, then what you can do is download my order flow book from here. It's free to download. If you like videos more, then you can watch a whole webinar on order flow trading. So if you go to the videos section in here, scroll down a bit, it's older video. Yeah, it's on page 3 in here. This is the webinar, all right? This is a recording of a webinar I had for NinjaTrader. This is it. So another free source where you can learn how to trade with order flow. But if you guys really want to bring your trading to a new level, then I recommend going to Trading Course and Tools and checking out the order flow pack. That's the next best step, I would say. It includes the order flow software, my custom-made software that I developed for NinjaTrader 8 platform, 12 hours video course on trading with order flow, and also because order flow very nicely works with volume profile, that's why this pack also includes volume profile indicator pack. Alright, those are my volume profiles that I developed for various trading platforms, including NinjaTrader, MetaTrader, TradingView, you name it. Alright, so that's for the Overflow pack. There's also a free tech support for Overflow pack members. Yeah, you are getting a lot of stuff. There's a video which you can watch. It will show you everything that's included in the Overflow pack. So check it out. And if you have any questions, we have a superb support. So click this quick chat window and we will help you in no time. So that's about that. That's about the video about volatility and spikes. I hope you guys liked it. Let me know what you think in the comments below. And I'll be looking forward to seeing you in some next video. Or if you decide to join one of our trading courses, then I'll be looking forward to seeing you in the members area. So until then, happy trading.